So we are discussing the chapter of the audit of the insurance companies, in which we had a general introductory discussion regarding the insurance company, and then we finished discussing regarding the audit of the revenue items. Like, we studied how to audit the premium income of a general insurance company, how to audit the claims of a general insurance company, how to do the audit of the commission of the general insurance company, and how to do the audit of the operating expenses of the general insurance company. Right, so these four items which we've completed over there are revenue items. Now we will talk about the balance sheet items for the general insurance company. Now we will talk about the balance sheet items for the general insurance company. And in the balance sheet item, which is the first item which we have over there, is the investments. In the balance sheet, what is the first item which we have over there is the investments. Okay, and now for these investments of the general insurance company, can again anybody make a guess of what could be the points or should be the points when I want to check the investments of the general insurance company? I need to check the existence, rights and obligation, completeness, valuation, and the allocation. Right, so for existence, what I need to do, obtain this physical verification. Rights and obligation, I need to check the ownership documents. Completeness, I need to check the purchase and sale of investments. Then whether valuation has been done in accordance with the IRDA rules and regulations. Right, whether valuation has been done as per the IRDA norms. Right, then we also need to check the income on the investments. Has it been duly accounted for? The income on the investments, has it been duly accounted for? Then any TDS certificates on these investments, any TDS certificates on the income received on the investments. Okay, right, so now you keep it in your mind. Like, I think one thing you've kept in your mind is 143.3. What is 143.3? Information proper, branch, books, AS, adverse, directors, maintenance, IFC, others. Likewise, now what you will keep in your mind for investments? ERCV. Okay, what do we need to check regarding the investments? We need to check the existence. For existence, what we can do? We can do the physical verification, or in case if it is not held by them, then you can obtain the confirmation from the depository or the third parties where the investments are held. Then I want to check the rights and obligations. So for that, I can check the contract note, whether it is the broker's note, and whether it is in the name of the insurance company. Then whether the investments has been done as per the IRDA norms, the valuation, classification, right? Then the completeness. Completeness means we are talking about the purchase and sale of the investments, and then talking about the valuation, right? So this is just an outline for you regarding how to write the answer for the investments of the general insurance company. Are you all with me? Audit procedures for the investments. What is the backup you will keep in your mind? ERCV. What is ERCV? These are the assertions addressed through substantive procedures for the account balances. Okay, so one, what does it say? If the investment scripts are with the custodian statement or DMAT or other equivalent account, what you can do? You can verify the investment scripts. So verify investment scripts means we are talking about the existence. Then whether all investment scripts are held in the name of the insurance company. That means we are talking about the rights and obligation. Then branch auditor should report whether adequate records are maintained in respect of those securities held by it on behalf of the branch office, right? So we are talking about the securities held at the branch office. Then investments are held by other person on behalf of the insurance company. Again, you need to obtain a certificate from such other person, right? So what were the first 2 points over there? Investment scripts, you need to verify the custodian statement, DMAT account or so. Second, you need to check whether the investments, all investments are in the name of the insurance company. So existence and rights and obligation. Then investments at the branch, whether adequate records are maintained. If investments are held by another person, then what you need to check? Obtain a certificate from him. Are you understanding that? Right? The investments at the branch, whether the adequate records. The investments held by any other person, obtain a certificate. certificate. Then what does it say? In case if the investments are done in the scripless dealing. Scripless dealing means what? The demat form, not in the physical format. Then in that case, what you can do? Acknowledgements can be obtained from the acknowledgements issued by the dealers and the confirmations of the depository organization. Do you know the depository organizations? The NSDL and the CDSL. Right? So what does it say? You can obtain the confirmations from the depository. Then expired securities. Examine whether the portfolio of the insurance company consists any of the securities whose maturity dates have already expired. So when you obtain the confirmation, then it should not include any securities whose maturity date has already expired. Then you need to check the method of accounting. So method of accounting means I'm talking about the valuation. Then the manner of accounting of the investment, is it in accordance with the IRDA guidelines and the accounting policy? So next I need to check the compliance with the IRDA guideline. Right, method of accounting, then the method of the valuation of the investments. Change constitutes a change in the accounting policy and adequate change disclosure regarding the change. So they are again talking about the accounting policy or the method of accounting, right? So method of accounting, manner of accounting, then the method of valuation of investment constitute change in the method of valuation of the investments, right? Then another set of points is check whether income from investments has been properly accounted for. Are they properly maintaining the TDS certificate? So these 2 points are regarding the allocation, right? These 2 points are regarding the, we say valuation and allocation. So these points are regarding the allocation. And in case if the investments have been pledged, hypothecated against borrowings by insurance company, again check whether a disclosure of such pledge hypothecation has been made, right? Again check whether a disclosure of such pledge or such hypothecation has been made. Okay, right? So what is the audit we are talking about now? We are talking about the audit of the balance sheet items of the general insurance company. In the balance sheet, which is the first item that we are talking about over there, is the investments. Investments, what is the backup which you need to keep in your mind? ERCV, the existence, rights and obligation, completeness, and the valuation and the allocation, right? So first 2 points are for checking the existence and the rights and obligation. Then investments which are held at the branch or investments which are held by another person. Then for the scripless dealings, you need to obtain the confirmations and the acknowledgements. Then it should not include any of the expired investments. Then after, what does it say? Method of accounting, manner of accounting, any change in the method of valuation of the investments. Then the income from investments and the TDS certificates and any investments which have been pledged or hypothecated, right? So that is one question over there regarding the audit procedures for the verification of the investments of the general insurance company. Are you listening to me? Audit procedures for the verification of the investments of the general insurance company. Right now we come to the audit procedures for the verification of the outstanding premium and the agent's balances. And I don't know what is the reason, but so many times this question has come in your exam, right? Around 6 times question has come in your exam regarding the outstanding premium and the agent's balances. Right, so question number 14 over there, which is regarding the outstanding premium and the agent's balances. Are you understanding that? Right, so outstanding premium and the agent's balances. So now we are talking about the outstanding premium, and second we are talking about the agent's balance, right? So outstanding premium, that means the premium is not yet received. That means, will the insurance company assume any risk in respect of outstanding premium? Will the insurance company assume any risk in respect of the outstanding premium? No. What did we say? No risk assumption without premium. You remember section 64(5)(b), right? So no risk assumption without the premium. So no risk has been assumed in respect of those policies where the premium is outstanding. Now it was outstanding, so whether subsequently it has been collected. So it was outstanding. So as an auditor, what you need to check subsequently whether it has been collected or whether any guarantee or any deposit has been kept for the outstanding premium. Whether any guarantee has been given or any deposit has been kept for the outstanding premium. And what you also need to check is the age-wise, sector-wise analysis of the outstanding premium. Age-wise, sector-wise analysis of the outstanding premium. Is it clear to everyone? Right, so premium deposit outstanding has been subsequently collected, then no risk has been assumed in respect of the outstanding premium. Then you also need to check the guarantee or the deposit for the outstanding premium, and you also need to study these age wise, sector wise analysis of the outstanding premium, right? The age wise, because since how many days it is outstanding, sector wise, for which sector how much is the outstanding premium. So age wise, sector wise analysis of the outstanding premium. Are you understanding that? Then insurance company, will it be having many agents and a commission agents? Will an insurance company be having many of these agents? Right, so again for all these agents, one, what you can do is you can review the control accounts. Then as an auditor, what are you going to check for? You are going to check for the huge outstanding. You are going to check for the old outstanding. You're also going to check the reasons why it is outstanding for such a long time, right? That why it has not been reversed or so. Right, so you're also going to look into the reasons for holding on the old outstanding balances over there. And you can also review the agent's balance. You can tally it with the general ledger. Right, you can tally it with the general ledger. So these are the points which we have for the outstanding premium and the agent's balance. Right, question asked 6 times in your exams. But what we need to do when we need to write down the point over here, first we have few set of points to be written regarding the outstanding premium and few set of points which we have regarding the agent's premium, right? We need to dissect, we need to divide the heading into two parts. What are the two parts? Outstanding premium and the agent's balances. Okay, right, so what does it say for the outstanding premium over there? One, you need to do the age wise, sector wise analysis of the outstanding premium. Then you also need to check whether the outstanding premium has been collected and check the availability of the bank guarantee or the deposit for the outstanding premium. So these 3 points which we have over here are regarding the outstanding premium. Right, and then other points which we have over there are regarding the agents balances. But first point is the common point. What is the common point over there? Inquire reasons for the long outstanding credit balances in the outstanding premium account and examine the reasons for policies not being issued on the outstanding premium for not adjusted against the amount due. Right, so you need to check for the reasons. So that is one point over there. Then what you can do, you can review the control accounts. Then you can check the inoperative balances, treatment inoperative balances and the treatment given for the old balances. Then inquire into the reasons for retaining the old balances. Then old debit balances which may require the provision or the adjustment. Notes of explanation may be obtained from the management in this regard. Right, so old outstanding, huge outstanding, inoperative balances. Right, again what you can do, you can obtain the reasons from the management in this regard. Right, so inoperative accounts, again you can obtain the reasons from the management in this regard. Right, so this is the question regarding the outstanding premium and the agent's balances. Right, so this what I will write over here, agent's balance. So what you need to do, you need to remember your answer in 3 parts. First part is what? Ascertain the reasons for the outstanding premium and so. Then you have the points regarding the agent's balance, and then you have the points regarding the outstanding premium. Right, 6 times question asked in your exam, so 100% you need to do the W for this one. Right, you need to do the writing practice for this one. Okay, then another balance sheet item of the insurance company is the unexpired risk reserve. Right, what have we discussed so far in the balance sheet items? Investments. Then we talked about the outstanding premium and the agent's balances. Now we are talking about the URR. What is URR? The unexpired risk reserve. Okay, right, so now what did I say? A policy holder has taken a policy on what date? 1st October 2024. Till when is this policy effective? Till 30th of September 2025. Okay. Now, if the fire occurred in the company premises on 25th of March or 28th of March, 31st March, when the insurance company closes its books of account, does it need to make a claim provision? 31st March, when the insurance company claims this, closes its books of account, does it need to make a claim provision? Yes, because the event has already occurred and the insurance company is yet to pay the amount. So that is why, does it need to make a claim provision? Yes, it needs to make a claim provision. Are you able to follow what I am saying over here? Okay, now say the fire did not occur up to 31st of March. And the policy was taken from 1st October to 30th September, but 31st March, the insurance company is closing its books of account and the event has not taken place. Can the event take place during the remaining term of the policy? Can the event take place during the remaining term of the policy? Is there any unexpired risk over there? Is there some part of the risk not yet expired? Is it going into the next year? Right, but when is the premium income recognized? It is recognized in the current year. So next year also in the first 6 months, if the fire occurs, will the insurance company have to pay the money? In the next 6 months also, if the fire occurs, will the insurance company have to pay the money? Yes, that is why on 31st of March, insurance company, when you close your books of account, you need to make a provision for the unexpired risk reserve. Though it is called a reserve, actually it is a provision and it is also a tax deductible expenditure under the income tax law. So the conclusion is very simple. If the fire has already occurred, then insurance company, what you need to do? Claims provision. If the fire has not yet occurred, but the policy is not yet expired, then insurance company, what you need to do? You need to have create the unexpired risk reserve. You need to make a provision for the unexpired risk reserve. Though it is called a reserve, it's actually a provision. It is also a tax deductible expenditure under the income tax law. Are you able to follow this, everyone? Unexpired risk, right? So what does it say? The need for the unexpired risk reserve arises from the fact that all policies are renewed annually except for the short period policies. So all policies are renewed annually. Now, since the insurer closed their accounts on a particular date, not all risk under the policies expire on that date. So 31st March, are all policies going to expire? No. Like say today I purchase a vehicle. Say today is 1st of October. Now, will I wait? No, only 1st April I will take the insurance policy. No, today if I purchase a vehicle, I will take the insurance cover today. And now will the insurance company close its books of account? Yes, on a particular date. Okay. What is a hypothetical situation where no unexpired risk reserve will be required to be created? What is a, like, just a theoretical assumption which we can make over there? If all the insurance policies are issued only on the 1st of April 2024. So all policies are for 1 year. All of them will expire on 31st of March. So you open your shop only 1 day in a year. Only on 1st April you issue policies. Rest of the year, no issuing policies, nothing. Then do you need to make a provision for unexpired risk reserve? Then there is no need to make a provision. But obviously, is this possible? No. Every day somebody purchases a vehicle, every day they take the insurance for the same. Right? So on the closing date, when the insurance company closes its books of account, does it have an unexpired liability for the remaining period of the policy? Right? So many policies extend beyond this date into the following year. So there is an unexpired liability under various policies which may occur during the remaining term of the policy beyond the year end. That's what I told you now. Okay, if the fire takes place, right? If the fire happens in the next 6 months also, will the insurance company have to pay the money for the same? Yes, the insurance company will have to pay the money for the same. Okay. Then what are the methods of creating this URR? It says there are two methods. One is the 1:365 method. So no 180 days policy current year, 185 days in the next year. So proportionate basis you do the calculation of the unexpired risk reserve. And another method is taking 50% of the premium amount. So whatever premium you've collected during the year, 50% of that you take it as the unexpired risk reserve. Right? So what are the two methods? One method is the 1:365 method, proportionate number of days, and second one is what you do? You take 50% of the premium amount. And is this again a tax deductible expenditure under the income tax law? Yeah, insurance companies are allowed to deduct a 50% in respect of fire and miscellaneous business and 100% of the net premium income for the marine insurance business. So these are the tax deductible expenditure under the income tax law, right? So again, in the question bank, we have a question on the unexpired risk reserve, and again one more question regarding the unexpired risk reserve. What does it say? AX Insurance Limited has made a provision of 75% of net premium in respect of the marine hull insurance and 50% in case of the marine cargo and the miscellaneous business of the net premium for the unexpired risk reserve. Now, what does it say? 1:365 method of 50% of the net premium. Here, what they have done? 75%. So, it is very good. They've done excess provision. So what does it say? Applying the above provisions to the given case. Both the provisions made by AX Insurance Limited are in order. And both the provisions made by them in order. Right. So question number 15 and 16. It is regarding the right, question number 15 and 16. It is regarding the unexpired risk reserve. Is it clear to everyone? Question number 15 and 16 is regarding the unexpired risk reserve. Okay. Now we come to another concept over there, which is regarding the reinsurance. Okay. And again, you need to listen to me very, very carefully. Okay. Right. So say there is insurance company A and there is the insurance company B. Let me make an assumption that who is my client? My client is insurance company A. I am doing audit of which insurance company? I am doing audit of insurance company A. Are you understanding that? Okay. Now, for my client, when will we say that it is the reinsurance inward? Right? And then second, it could be the reinsurance outward. Right, reinsurance inward or the reinsurance outward. Now for my client, when will it be the reinsurance inward? When my client is the reinsurer and some other insurance company is the reinsuree or the ceding company. And for my client, when will it be reinsurance outward? When my client is the ceding company and the other insurance company is the reinsurer. Okay. So look over here. I am insurance company A and this is insurance company B. Some of their policies I am reinsuring. So I am a reinsurer. And some of my policies I am getting that reinsured from them. Then I am the ceding company and the other company is the reinsurer. Are you understanding that? If I reinsure some other insurance company policy, I am a reinsurer. So it is reinsurance inward. And if I get some of my policies reinsured from another insurance company, then it is reinsurance outward. In that case, I am the ceding company. Are you able to follow this, everyone? Very simple. You keep it in your mind. Reinsurance inward. Reinsurance inward, my client is the reinsurer. Everything else has to be the balancing figure. Whereas then ceding company, then here ceding company and the reinsurer. Clear to everyone? Verification of the reinsurance inward and reinsurance outward. Right. So now what will happen in case of reinsurance inward? They have issued policies. I am reinsuring them. So they will give me the premium. I will give them the claim and obviously I will charge them the profit commission for the same. Are you understanding? And if it is reinsurance outward, then I will have to pay the premium. I will get the claim and again I'll have to get the profit commission, give them the profit commission for giving the reinsurance services. Are you understanding that, everyone? Depending upon whether it is reinsurance inward or outward, according to the premium and claim ka points, do they undergo a change? Right, reinsurance inward, do I receive the claim or do I pay the claim? Reinsurance inward, do I receive the claim or do I pay the claim? Reinsurance inward, I receive the claim. I receive the premium. What you say? Do I receive the premium or do I receive or pay the premium? Reinsurance inward, do I receive the premium or do I pay the premium? I receive the premium. And reinsurance outward, do I have to pay the premium? Reinsurance outward, I need to pay the premium. Okay, right. Then over here, we also have a discussion regarding the types of the reinsurance contracts, right? So we have one more discussion over there, which is regarding the types of the reinsurance contract. And these reinsurance contracts have been divided under two types. One is the facultative reinsurance and second is the treaty reinsurance. And under treaty reinsurance, we have two. We have the proportional treaty and the non-proportional treaties. Right? We have the proportional treaties and we also have the non-proportional treaty reinsurance. Right? So we are talking about the types of reinsurance contract. What are the types over there? Facultative and the treaty. Treaty means what? You enter into an agreement. Treaty means what? You enter into an agreement. Right now, facultative. That means say these are the insurance policies which I have issued during the year. I am insurance company A. Listen to me carefully. Right, November 2008. Right, there was a question asked only on the facultative reinsurance over there for 4 marks. Right, facultative reinsurance. And then in November 2016, proportional and non-proportional treaty. And then after that, there is a question on verification of reinsurance outward. Then the verification of reinsurance outward. Right, so these are the questions which we have regarding the reinsurance 17, 18, 19 and 20. Right, 17, 18, 19 and 20. So question number 17, 18, 19 and 20. It is regarding the reinsurance. Is it clear to everyone? Okay. Right. So now, say during this year, I am insurance company A and I have issued all these insurance policies. Okay. And now this is insurance company B and I am getting my policies reinsured from them. So I look at one policy document and I tell them, okay, what you do now, this policy, you reinsure it by 10%. Then they say, okay, let me see if I can accept it. They say, yeah, we can accept it. So they say, okay, we will reinsure. Then I take out one more policy and then I say, this policy, now you reinsure it by 40%. So they say, okay, let me see. They say, no, we cannot reinsure it for 40%. So then that got cancelled. Then again, I take out one more insurance policy and I say, this policy, reinsure by 60%. So again, they have a look at it, the other insurance company. They say, okay, we will reinsure this policy. Right? So what you need to understand that here the reinsurance is done policy wise. And sitting down one policy I'm taking out and I'm asking them reinsure. Individually I'm discussing the terms and conditions of each of the reinsurance. Right? This is the oldest method of getting the reinsurance done. And what is the biggest drawback of this method is the huge volume of the work. So much time you have on earth. Take out one policy and tell them this policy 10%, this policy 20%, this policy 30%. Huge volume of work. But till today, it is in use. Why it is in use? Because it says, say I have issued 1,000 policies. Out of 1,000 policies, in 2 policies, there is an abnormal risk. Right? So what I can do for the 998 policies, I can enter into a treaty reinsurance. And for these 2, where there is an abnormal risk, what I can do, I can enter into a facultative reinsurance. I say I don't want to get them covered in the treaty. I don't want to get them covered into the wholesale deal. I want to specifically get them reinsured. So that is the facultative reinsurance. You don't want to get some of your insurance policies getting covered in the treaty reinsurance. Are you understanding this, everyone? Right, facultative reinsurance. Oh my God, MCQ, favorite question. I know the insurance has been done policy wise, and which type of reinsurance is it? Right, so they say facultative reinsurance, and the treaty reinsurance, proportional treaty, or the non-proportional treaty. Right, so what is the answer over there? It is the facultative reinsurance. Okay, right, so did I already explain to you ceding company and reinsurer? Right, ceding company and the reinsurer. And did we also discuss this types of reinsurance contract, facultative and the treaty? And under the treaty you have the proportional and the non-proportional treaty. Okay, and then this is the table which is there in the study material of ICAI. Even the colors are same. And the same page I have picked up and put over here. Now what they have done, they have given under the proportional treaty that it could be quota, share, surplus, auto, fac, or the pools. And for non-proportional, they've given that it could be the excess loss treaty or the stop loss treaty. But where they've given the theory over there, they've not given the explanation in the theory over there. Right, so though they have given these classifications over here, have they given the explanations in the study material of ICAI? No, they've not given the explanations in the study material of the ICAI. Are you able to follow this, everyone? Right, so types of reinsurance. The facultative reinsurance, what does it say? The contracts relates to one particular risk and is expressed in the reinsurance policy. One particular risk, policy wise, you getting it? Reinsured. This is the oldest method of reinsurance, and it necessitates consideration for each risk separately. Each transaction under facultative reinsurance has to be negotiated individually. I told you, na, this one 10%, this one 20%. So it has to be negotiated individually. Each party to the transaction has the free choice, the ceding company to offer and the reinsurer to accept. So what I said, okay, this one reinsure, this one don't reinsure. They say, this we accept, this we do not accept. So both parties have the free choice. If the ceding company to offer and for the reinsurer to accept. Then the main drawback of this method is the volume of work involved and the time taken to cover the risk. However, still it is used even today. Why? Because the risk is excluded from the treaty or the automatic covers have already been exhausted. The insurer does not want his reinsurance treaties overburdened with the particularly heavy abnormal risk. Then what does it say? Either the automatic cover has exhausted or there is no automatic cover at his disposal. Right, so that comes under the stop loss and the excess loss and the stop loss treaty. That, you know, if I suffer a loss of up to 100 crore, reinsurer, you will pay me the money. And it says that 100 crore is already covered. And that 100 crore loss is already, that much of liability has come. So now what you do? Now you go for the facultative reinsurance, where the automatic cover is already exhausted or where there is no automatic cover at his disposal. And the nature of business is such that technical guidance or consultation with the reinsurer is required at every stage of acceptance of the risk, or for a type of business where the number of risk is very small. For example, in the atomic energy installation, the oil rigs, etc. So there, what type of reinsurance do they go for? They go for the facultative reinsurance, right? What type of reinsurance do they go for? They go for the facultative reinsurance. Is it clear to everyone? Right, so that's regarding the facultative reinsurance. Okay, automatic covers exhausted, no automatic cover, excluded from the treaty. Why excluded from the treaty? Because there is an abnormal risk, right? Then what does it say? Automatic covers are exhausted or there is no automatic cover, and it may require technical guidance or consultation at every stage of the acceptance of the risk. Okay, right? So is a separate question asked in your exams regarding facultative reinsurance? Facultative reinsurance, yes. And now coming to the treaty reinsurance. Treaty is where you enter into an agreement between the ceding company and the reinsurer, where reinsurances are within the limits of the treaty. And these limits can be monetary, geographical, section of business, etc. Right, that is what you say, up to 100 crore you insure, give me a reinsurance cover. This is what monetary. Or all my North India, yes, whatever policies we have issued for the North India, what does it say? Those policies you please reinsure. And those policies you reinsure. Or also, what could it be based on? The section of the business, that all my marine insurance policies, those you reinsure. Right, those you reinsure. So what is it? You are entering into an agreement. This agreement is called as the treaty. Are you understanding that? So there is a predetermined ratio, there is a predetermined percentage. Okay, now again, what do you say? You are entering into an agreement. So now I'm not taking one policy and discussing 10%, 20%, 30%. Now I'm talking at a bulk level, wholesale level. Right? So first thing very important over here, you have to decide the scope of the treaty. And it is obligatory for the ceding company to cede risks in accordance with the terms of the treaty. So first you have to decide the scope of the treaty, okay, which type of policies you want to cover, which section of your business you want to get it reinsured, what is the amount you want to get it reinsured, what is that? That is the scope. Scope can be determined how? Based on the monetary, geographical or the section of business, etc. Are you understanding that? Then once you determine the scope, only that much will be reinsured. Then in case of treaty reinsurance contract, the insurer prepares a statement. So now is the scope determined? Now, is the scope determined? Yes. Now, based on the scope, they will prepare a statement of the treaty reinsurance contract and send it to the reinsurer for the purpose of the reconciliation of the claims lodged under the reinsurance contract, the outstanding claims paid, and the claims paid in advance. Right? So, one, what does it say? You enter into an agreement. Now, that agreement, you have to define the scope. Then, based on the scope, you will send the statement and they will reconcile. Right. Then after that, what does it say? If it's a large claim, then what may happen? The reinsurer may pay you in advance also. In the event of any large claim, reinsurer shall make payment even before the claim is finally settled or the statement of the treaty reinsurance is received by the insurer. So even before receiving the statement, the reinsurer may pay. So these treats the amounts paid to the insurer as advance against the claim. So in case of large claims, what does it say? They can pay the advance amount, right? So how much advance amount is paid? 100 crore. And say later on how much the actual liability came to? 120 crore. So now the reinsurer needs to pay how much? More 20 crore. This 20 crore is referred to as the cash loss payment. This 20 crore is referred to as the cash loss payment. Are you understanding? Right. So loss means it's not literally a loss. They just use the terminology over there called as the cash loss payment. The advance against claim account is squared up as and when the claim is settled, and the information of the settlement is sent to the reinsurer through the statement of treaty reinsurances, and such payments by the reinsurer are called as the cash loss payments. Are you understanding? Can there be a retail question in your exams regarding the cash loss payments? Right? Can there be a retail question over there? Yes, that is the concept of the cash loss payments. Okay, so does everybody understand treaty reinsurance? There is an agreement. So first you need to determine the scope of the treaty. Then based on that you need to send the statement. Then the reconciliation would be done. Then large claims, even the in the large claims, the advance payment of the claim could also be done. And when the claim is actually settled, the balance amount could be paid, which is also called as the cash loss payment. Is it clear for everyone? Right. Then you have the proportional treaty and the non-proportional treaty. Proportional treaty, which are based on predetermined percentage or ratio. So out of all the policies which I have issued, what does it say? 30% reinsured. So not 1-1 policy. And if I do 1-1 policy, then it is facultative reinsurance. I pick up all the policies which I've issued, all the fire insurance policy, and I say all these policies 30% reinsured. Then what is that? That is a proportional treaty. That is a proportional treaty. Such treaties are based on pro rata apportionment of the sum insured, the premium and the losses according to a predetermined percentage or ratio, right? So that's the proportional treaty. And non-proportional treaty are characterized by sharing of the liability between the ceding company and the reinsurer, right? Between the liability of the ceding company and the reinsurer on the basis of the loss rather than the sum insured. Right, so you're not looking at what is the amount of the loss incurred, the sum insured. Here you see how much is the sum insured, 100 crore. Here what you see, how much is the loss? How much is the loss? Say the loss is 200 crore or so. So based on that, the non-proportional treaty is determined. And the following are the other characteristics. So one, what is the characteristic of a non-proportional treaty? Here the focus is on the, right? Here the focus is on the loss rather than the sum insured. Non-proportional treaty, the focus is on the loss. So there the focus is on the loss. Okay, now premium is not collected on each session, but on the whole portfolio of the ceding company. So again, this loss is calculated not individually, but on the whole portfolio. Then what does it say? The premium rate is predetermined. Premium rate means which the premium which the ceding company needs to pay to the premium which the ceding company needs to pay to the reinsurer. It says the premium rate is predetermined. Then the cost of reinsurance can vary substantially each year depending on the premium income loss ratio and the reinsurance mark situation. So again, the cost may vary substantially each year and normally no commission is paid. Right, so generally for facultative or the proportional treaty, do we have to pay the profit commission to the other to the reinsurer? Yes, but in this case, do you pay the profit commission? No, no commission is generally paid. Okay, I am anticipating that they may ask a retail question in your exams regarding the non-proportional treaty. Are you understanding that, right? Retail question. right? Because they've asked facultative insurance, they've asked types of proportional types of treaty insurance. Now the question which they can next ask is the non-proportional treaty. So here it is based on the sharing of the liabilities, it is based on the loss, and are characterized by the sharing of the liabilities. It is based on the loss rather than the sum insured. Then it is on the whole portfolio. The premium rate is predetermined. Cost of reinsurance can substantially vary each year, and generally no commission is paid. Okay. And now we come to two questions over there: verification of reinsurance inward and then the verification of the reinsurance outward. Are you all with me? Now coming to the next 2 points of discussion over there, which is regarding the verification of the reinsurance inward and the verification of the reinsurance outward. What I will do, I will prepare a common list of these points over here. Okay, and then you know, okay, for inward what you need to write in which way. If it is reinsurance inward, premium will be, if it is reinsurance inward, premium will be received. And if it is reinsurance outward, then premium will be paid, right? So that you need to keep it in your mind. Okay, right? So again, we are preparing a backup of what we can write in our answer for the verification of reinsurance inward and outward, right? So number one, for it to look like an insurance company question, you write that check compliance with the IRDA Act and the regulations. Then also verify the internal control system. Then also look into the company's approved program for entering into such type of the reinsurance contracts. Okay, right. Then after that, what it says, you can check the agreement which has been entered into with the reinsurer or the ceding company. Then you can also check the statements, and you can also check the advices. And as an auditor, you can also obtain the confirmation from the other insurance company. It could be reinsurer or the ceding company. Then the 3 points which you need to know over there is regarding the premium, the payment or the receipt of the premium, then the payment or the receipt of the claims, and then you also need to check for the profit commission. Right. Can reinsurance be provided by foreign insurance company? No, get up. Manu is saying no, get up. Right? Okay, no problem. Right? So foreign insurance company, right? Foreign insurance company, can they provide the reinsurance business? They can only provide reinsurance business through a branch established in India. Are you understanding that? Okay, right? So what does it say? In case of foreign currency transactions, check the compliance with the AS11. Right, the foreign currency transactions, you need to check the compliance with the AS11. Then last year you got 30% of your policies reinsured. However, this year you're only getting 20% of your policies reinsured. So in that case, what are you doing? You are doing a portfolio withdrawal. So again, ascertain the reasons for the portfolio withdrawal. And now, if you've got 20% of your policies reinsured or 30% of your policies reinsured, how much liability will come on you? That again, what is required for the same is an actuarial estimate is required for the same. Right, an actuarial estimate is required for the same. So anyways, we have 12 points over here, and in the exam the question comes, it won't come beyond 4 to 5 marks over there, right? So verification of reinsurance inward and the verification of the reinsurance outward. Is it clear to everyone? Verification of the reinsurance inward and the verification of the reinsurance outward. Are you all understanding that? Okay, reinsurance inward, what will I write over? Okay, sorry, reinsurance inward, what will I write over here? That the client is my client is the reinsurer. And in case of reinsurance outward, what will I write? My client is the ceding company. Are you understanding that, everyone? Okay, right. And then let us read the points over there. What does it say? Ensure compliance with the guidelines prescribed by the Insurance Act and the IRDA regulations. Okay, now by mistake this point has come over here. This last point is again the compliance, but that has to come under the reinsurance outward. Are you getting what I'm saying? First point is also compliance, last point is also compliance, but that compliance ka point is the first point of the verification of reinsurance outward. And that is the first point for the verification of reinsurance outward. Okay. Then reinsurance inward. Are you all with me? Client is reinsurer. So you need to check the inward acceptances. Are they in accordance with the company's approved program? Then you need to check the reinsurance inward acceptance are as per the agreements entered into with the Indian or the foreign insurance company. Then you also check the periodic accounting statements received in connection with the agreement. Then proper closing returns have been received for premium and claim for the facultative acceptances, right? So proper details of the premium and claim for the facultative acceptances. Then check accounts for closure of any underwriting portfolio withdrawals. Did I tell you about portfolio withdrawal? Okay, last year they had got 30% reinsured. This year getting only 20% reinsured. Then what does it say? In case of foreign currency transaction, check compliance with the AS 11 or the Ind AS 21. Then the profit commission, has it been calculated as per the agreement? Then run off claim or large claim, then what does it say? Check whether it requires any provision. So large claim has come on the reinsurer. You need to check how much provision they need to make, right? So that point we've already written over here, the claims provision. Right. Then also what does it talk about? Appropriate provision for incurred but not reported claims has to be done on the basis of the actuarial estimate. So actuarial estimate. Then again, closing balances of the reinsurer's account should be reconciled and the confirmation of the balances should be obtained from all the companies. So that's the confirmation. Then where the verify the requirement of provision or write-off of the reinsurance inward balance based on the doubtful nature of the recovery. So I gave the reinsurance. Insurance company A gave the reinsurance. Okay, so in that case, I am going to receive the premium, but it looks doubtful that I will receive the premium. So that says you need to make a provision for if it is doubtful nature of the recovery. And then this is the first point for the next heading, reinsurance outward. Right. So is it similar to the table that we have prepared over here? The verification of reinsurance inward and outward. Right. Now let us look into the points for the reinsurance outward, wherein your client is the ceding company. So verify that reinsurance underwriting returns received from the operating units regarding premium, claim paid, outstanding claim, etc. Then the pattern of reinsurance underwriting. So this is also called as what? Outward is also called as the underwriting. And so where we've prepared our table of reinsurance outward, what we can say, we are doing the underwriting. Okay, if we are not able to pay, who will pay? The reinsurer will pay. That is what? If the public do not subscribe to the shares of the company, the underwriter will subscribe, like that. Here, what does it say? If ceding company is not able to pay, then who will pay? Right? Who will pay over there? The reinsurer. So who is the reinsurer over us? Over here for us, he is like the underwriter. Okay, right? So the pattern of reinsurance underwriting. Then the sessions have been made as per the stipulation applicable to the various category and the agreements entered into with the various companies. Then for foreign reinsurers, check the foreign exchange regulations. Then commission on the session has been paid. Computation of the profit commission. Then also the cash loss recoveries have been claimed. Then any provision for the outstanding losses and aspects of reinsurance session, premium, commission receivable, paid claims recovered, outstanding losses, and so, right? So those are the accounting aspects you need to consider. Then percentage pattern of gross to net premium, reinsures balance on sessions and whether sub-ledger balances tally with the general ledger. Now this is again a general point which we can always write, whether sub-ledger balance tallies with the general ledger. Then individual accounts, do they require the provisioning? Then reinsurers are supported by the necessary confirmation, and you can also check the events after the balance sheet date, right? So reinsurance inward, and then you have the reinsurance outward. Okay, right? So that completes one more part of our discussion over there, which is regarding the reinsurance. Then after reinsurance, next discussion over there is regarding the co-insurance. What is co-insurance? More than one insurance company coming together and provide the insurance cover to a policy holder. So just as in case of audit, we had the joint audit. In case of bank, you have the consortium loan. Now here what you have is the co-insurance, right? So again, co-insurance, there could be two types of arrangement over there. right? In case of the co-insurance also, what does it say? Again, insurance company A, and then there is the insurance company B, right? And again, who is my client? My client is insurance company A, right? Say my client is insurance company A, and what it could be? It could be the incoming co-insurance, or it could be the outgoing co-insurance. It could be the incoming co-insurance, or it could be the outgoing co-insurance. Okay, incoming co-insurance is when my client is the co-insurer and some other insurance company is the leading insurer. An outgoing co-insurance when my client is the leading insurer and the other insurance companies are the co-insurer, where the other insurance companies are the co-insurers. Right, so that is incoming and outgoing. Incoming, when some other company is the leader, you are only one of the party of the co-insurance, right? So for you, it is the incoming co-insurance. And outgoing co-insurance, when you are the leader and you have to settle the accounts with all the other insurers, right? With all the other co-insurers. Are you understanding that? Incoming co-insurance and the outgoing co-insurance. Are you able to understand this, everyone? Okay, right? So what is co-insurance? It says more than one insurer for the same transaction of risk. It amounts to co-insurance, right? So for the same transaction, right? And then balance pertaining to the other companies relating to premiums and claims are accounted as under co-insurance as amounts due or due to or due from the other insurance company. Where will it be amount due to? When it is outgoing co-insurance, and due from when it will be the incoming co-insurance, right? So due to or due from the other insurance company. And the insurance council may recommend the following terms while entering into the co-insurance agreement, right? So again, a question not asked in your exam so far, right? They could ask a retail question on this one. Okay, what are the points to be taken care of while entering into the co-insurance agreement, right? So what are the points to be taken care of? One, who will do the settlement of the commission? Second, who will collect the GST? Are you understanding that? Because now there is more than one insurer, so it has to be agreed who will pay the commission to the agents, who will collect and pay the GST, then what will be the standard practice for settling of the dues, then who will do the settlement of the claim. Then in co-insurance, if there is any reinsurance, then reinsurance arrangement and the exceptional booking and the powers thereof deviating from the insurance council's understanding. So something rare happens, right? So how the exceptional booking is done for the same, right? So insurance company council may recommend the following norms while entering into the co-insurance agreement. What are the norms? Who will do the settlement of the commission? Who will do the payment of the GST? Who will do the payment of the dues? Who will do the settlement of the claims, right? So they are talking about the settlement of commission, settlement of dues, settlement of claims, right? Then after that, the remittance of the, right, the remittance of the GST and the reinsurance arrangement and the exceptional booking and the powers thereof. Right, so that is the co-insurance agreement. Are you understanding that? Okay. Then coming to the next discussion over there, solvency margin, again ATF. Right, solvency margin. So now coming to the next round of discussion in this chapter, which is regarding the solvency margin. Solvent. When would you say that a person is solvent? When the assets are more than the liabilities. Okay, so what does it say? Every insurer shall assume that at any point of time or at all times during the year, it shall maintain an excess of value of assets, excess of value of assets over the amount of the liabilities, which shall not be less than 50% of the minimum paid up share capital of the insurance company. What is the minimum paid up equity share capital? 100 crore. So how much should be the solvency margin? 50 crore, right? 50 crore, right? 50% of the minimum paid up share capital. Are you understanding that? Excess of value of assets over the amount of liabilities to be maintained by insurance companies at all times. That means for 365 365 days, not only on the last day of the financial year, right? Not only on the last day of the financial year. Question number 21, right? What does it say? Three times question asked in your exams, right? MPS, an associate chartered accountant, started the statutory audit of their client Contingencies, a general insurance company which has a paid up capital of 16,800 lakh. During the course of the audit, it was found that the company was not maintaining the required solvency margin as per the provisions of the Insurance Act. When the issue was escalated to the management, they replied that solvency margin needs to be maintained as per the limits prescribed only on the last day of the financial year. Comment whether the reply of the management is tenable or not, right? So what does it say? Therefore, in the said case, Contingencies has not maintained the solvency margin throughout the year. Accordingly, contention of the Contingencies that solvency margin is required to be maintained as per the limit only on the last day of the financial year is not tenable, right? It is not tenable, right? So question number 21 is regarding the solvency margin. Again, a question asked three times in your exams, right? The solvency margin. So what does it say? An excess of value of assets over the amount of liability, which shall not be less than 50% of the minimum paid up share capital arrived at in the manner specified by the regulations. Are you understanding that? Okay, right? So let's take an example. Everybody, please listen to me carefully. Now say, even if you have 1 rupee more than your liability, 1 rupee more of asset than your liability, are you solvent in normal accounting terms? Are you still solvent? Yes. But insurance company says no, you should have 50 crore more asset than your liability. Only then you will be considered to be solvent. Okay. So now say this insurance company is having the assets of 1000 crore. I'm just taking some numbers over here. Pay attention. The insurance company is having the assets of the 1000 crore and they are having the liabilities of say 900 crore. Are they solvent? Right, 1000 crore and liabilities of the 900 crore. So are they solvent? Yeah, they are very solvent. 50% of the minimum paid up share capital is how much? 50 crore. Here, how much is the excess of value of assets over the amount of liability? 100 crore. So are they solvent? They are very solvent. Are you understanding? Then say again, I'm just to keep the example simple. Now say their liabilities increase to, now say their liabilities increase to 920 crore, right? 920 crore. Now also are they solvent? Yes, but now how much is the solvency that they are able to maintain? 80 crore. Then say again assets are 1000 crore and now say their liabilities are how much? 940 crore. So how much is the solvency? 60 crore. Are they still solvent? Are they maintaining the solvency margin? Yes. But is there some signal over there that the solvency margin is coming down? So it says rather than waking up from your sleep just when it comes to 50 crore, it says the authorities may by way of a regulation, the IRDA authority may specify a CLSM. What is a CLSM? They may specify a control level of the solvency margin. The authorities by way of a regulation may specify a control level of a solvency margin. What is control level of solvency margin? It is more like a warning bell. Insurance company, things don't seem to be going good, you please wake up and do some, take some corrective actions over there. So if at any point of time an insurance company is not able to maintain the CLSM, not the SM, they are not able to maintain the CLSM, they have to submit a financial plan to the IRDA authority. Okay, what are the steps being taken by them to correct the deficiency? What are the steps they are taking in order to correct the deficiency? Are you understanding that? If at any point of time the IRDA, if the insurance company is not able to maintain the CLSM, they have to submit a financial plan to the authorities saying what steps are they taking to correct the deficiency. Can the authorities call for additional information? Yes, they can call for the additional information also. And then also what does it say? That if at any point of time it is found that the insurance company is not able to maintain the excess of assets over the amount of liability, that means say excess of asset over the amount of liability is 40 crore. Normal accounting terms, are they solvent? Yes, but as per insurance law, are they solvent? No. Because how much is required is 50 crore and how much it is coming to 40 crore. What does it say? It will be deemed to be insolvent. It will be deemed to be insolvent, and they may also order a wound up the insurance company in the court of law. Right, so if any point of time the insurance company is not able to maintain the excess of value over the amount of liability, it will be deemed to be insolvent and the court may pass an order for winding up of the insurance company. Are you understanding that? Solvency margin. So one point we study excess of value of assets over the amount of liability. Then the authority by way of a regulation can also specify a CLSM. What is CLSM? They may specify a control level of solvency margin. And if any insurer or reinsurer does not maintain the CLSM, the control level of solvency margin, are you seeing that? Does not maintain the control level of solvency margin, they have to submit a financial plan to the authority indicating the plan of action to correct the deficiency. Can the authority require them to modify the financial plan? Yes. And maintenance of solvency margin has great importance for an insurance company. And if an insurer or reinsurer fails to comply with the prescribed requirement of maintaining the excess of value of assets over the amount of the liabilities, it shall be deemed to be insolvent and may be wound up by the court on an application made by the authority. Right, it may be wound up by the court on an application made by the authority. Right, so that is regarding the solvency margin. So what they pick up, no, at all times, and they pick that point and they made a case study in the exam. Right, at all times, which shall not be less than 50% of the minimum paid up share capital. Are you understanding that? Okay, right. Then contingent liabilities. Now, yesterday had we discussed the contingent liabilities for a bank? What we had studied, claims against the bank not acknowledged as debts, right? Then liabilities on the outstanding forward exchange contracts, right? Then after that we had studied the guarantees given on behalf of the constituents. Do you remember that? Right, guarantees given on behalf of the constituents, right? So are these similar ones over here? Claims against the, other than those under policies not acknowledged as debts, then guarantees given by or on behalf of the company. Then what are the other three points over here? Right, what are the other 3 points over there? Partly paid up investments, because whenever that uncalled part is called for, will the insurance company have to pay for that? Yes, so it is a contingent liability. Then the underwriting commitments which are outstanding. Underwriting means where they have done the reinsurance. Right, reinsurance, underwriting commitments which are outstanding, then reinsurance obligation to the extent not provided for in the books. Right, so to the extent provided for, provision; to the extent not provided for, it is a contingent liability. And then statutory demands, liabilities in dispute, and others to be specified. Right, so just as we had the contingent liabilities of the bank, similarly we also have the contingent liabilities of the insurance company. Right, similarly we also have the contingent liabilities of the insurance company. Right, so is a question asked in your exams? Yes, there is a question regarding the contingent liabilities of the insurance company. Right, question number 22. Right, the question number 22. So what are the 2 points? Claims other than those under policies not acknowledged as debts, guarantees given on behalf of the company, then partly paid up investments, underwriting commitments, reinsurance obligation to the extent not provided for, statutory demand liability, and the others to be specified. Okay, and then you have another discussion over there which is regarding the trade credit insurance. Right, so again a question asked 2 times in your exams regarding the trade credit insurance. Right, so that is question number 23, which is regarding the trade credit insurance. Are you all with me? Right, now the next question over there which is regarding the trade credit insurance. Okay, right, so what is this concept of the trade credit insurance? Are you all listening to me? Right, what concept are we discussing now over here? The concept of the trade credit insurance. Okay, so say there is a supplier, and the supplier, and a supplier, he has a big store, big godown, right? And what is the supplier selling? Can you think of what he can be selling? Say he's selling paints and narrow lac paints, or the Asian paints, or different types of paints he's selling, or he is selling the cement, or he's selling the beautiful, colorful, nice design umbrellas he is selling, or he's selling the mangoes or the strawberries or something like that. And he's a supplier. Right? What is he? He is a supplier and he is selling these things. Like, say, let's take example, he's selling umbrellas and a beautiful color, beautiful print, and a beautiful design. So small size of the very small, then the big stick type of umbrella also, such a big jumbo umbrella also, small umbrellas, different varieties of umbrellas being sold by him. Okay, now these umbrellas, he is selling them on the credit. He's selling them not on cash basis, but on the credit, right? So there is a supplier, and this supplier is selling the umbrellas on the credit to the buyers. And now, so he tells the buyer that you need to pay me after 2 months, right? So 2 months is the credit period that he gives. If the buyer pays after 2 months, wonderful. But what is the risk? That the buyer may not pay. Why the buyer is not paying? One, they say the buyer became insolvent, right? Or protracted default. Okay, certain number of days after the due date also the buyer does not pay. What was the due date? After 2 months. After 2 months, one more month is over, but still the buyer has not paid. After 2 months, one more month is over, but still the buyer is not paid. Or political risk cover. This is available when the buyer is situated in another country. Say you had sold the umbrellas to somebody who is there in Ukraine and Russia. You understand over there. So you say it's okay if I don't receive the money for my umbrella. Okay, right. So now, what does it say? There is a risk of the bad debts. For the supplier, there is a risk of the bad debts. Why bad debts? Due to the insolvency of the buyer, or due to the protracted default, or due to the political risk cover when the buyer is situated in another country. So the supplier can take from the insurance company a trade credit insurance. Right? So insurance of bad debts is a trade credit insurance. Are you understanding? So I am selling goods on credit. Maybe my customers don't pay to me on the due date. So if the customers don't pay, no problem. I have taken an insurance policy. The insurance company will pay to me. Are you understanding that? It is an insurance of the suppliers. It is an insurance taken of the, who is getting insured over here? The supplier, against the risk of non-payment of goods and services by the buyer. What is the risk for the supplier? Non-payment of goods and services by the buyers. And this non-payment is as a result of insolvency of the buyer, protracted default, or the political risk cover. Are you understanding that? Who is taking this insurance cover? The supplier. Against what risk? Risk of non-receivables, and a loss of receivables from the debtors, and a loss of receivables from the debtors. And why the debtors are not paying? Because they became insolvent, or there is a protracted default, or what does it say? A political risk cover. Okay, so trade credit insurance means, business means the business of effecting contracts of insurance in respect of the trade credit insurance transaction. Okay, right. Then now trade credit insurance means further insurance of the suppliers against the risk of the non-payment of goods and services by the buyer, who may be situated in the same country, domestic risk, or the buyer may be situated in another country, that is the export risk. And the non-payment is as a result of, why the buyer is not paying? Due to the insolvency of the buyer, or non-payment after an agreed number of months after the due date. So protracted default, or non-payment following an event beyond the control of the buyer or the seller. So that is the political risk cover. Right, so that's the political risk cover. So what is this? Trade credit insurance. Are you understanding that? Insurance of suppliers against the non-payment of goods and services by the buyer, and buyer may be in the same country or another country, and this non-payment is as a result of insolvency of the buyer, protracted default, or the political risk cover. Okay, then there are some basic requirements of a trade credit insurance product. Okay, what are the basic requirements of a trade credit insurance product? Right, one, okay, so you say, oh, I want to take an insurance of bad debts, insurance of bad debt. So one, what does it say? There should be a policy supplier, there should be a supplier who is selling the goods at the fair market value. And so you should be selling the goods, the supplier should be selling the umbrellas at the fair market value. Then what is the loss of the supplier? The loss of the supplier is the non-receipt of the trade receivable. Right, so there should be a supplier who should be selling the goods at the fair market value. What is his loss? His loss is non-receipt of the trade receivable. Then what? He has taken a trade credit insurance policy, right? Policy holder who has a customer a trade receivable, and he has taken a policy for the same in accordance with the policy document. He's also paid the premium on the policy on time. So policy holder has taken a, the supplier has taken a policy. He's also paid the premium on the policy on time. Then what does it say? This policy holder's trade receivable does not arise out of the factoring or the reverse factoring. So you go for one of it now. Either you get a trade credit insurance or you get the factoring done. You cannot get factoring also done, and you also cannot get trade credit insurance. You understand that? Either one of the two. So does not arise out of the factoring or the reverse factoring, and any other requirement as may be specified by the authority from time to time. Right, so total how many points we have over there? 6 points. What are the 6 points? There is a supplier who is selling the goods at the fair market value. What is his loss? Non-receipt of the trade receivable. He has taken a trade credit insurance policy. He has paid the premium on the policy on the time. The trade receivable is not coming out of the factoring or the reverse factoring, and any other requirement as may be specified by the authority from time to time. Right, so that's the discussion regarding the trade credit insurance. Okay, right, so what have we discussed over here? In the balance sheet items, we started with the investments. Then we studied outstanding premium and the agent's balance. Then we studied regarding the unexpired risk reserve. So that completed the balance sheet items. Then we talked about the reinsurance and the co-insurance. The reinsurance inward, reinsurance outward. Then the co-insurance. Then the solvency margin. Then the contingent liabilities of insurance company. And then regarding the trade credit insurance. Right. So now we will come to the discussion regarding the life insurance companies. Right, now coming to the discussion regarding the life insurance company. So one discussion over there, question not yet asked in the exams, is regarding the types of life insurance product. Right, so that relative of yours who is an LIC agent, they can teach you this topic. You understand? You just ask them, okay, what type of policies are there? They will be so interested. They think, oh, maybe you're thinking of taking a policy from them. Then you say, no, I don't want to take policy. Exam question, syllabus mate is there. That is why I'm asking you. You understand? All right, so one question over there is regarding the types of the life insurance product. Okay, right. Then after that, what are the other points which we need to discuss regarding the life insurance company? One, the actuarial process. Right, the actuarial process. Then the underwriting being done in the life insurance company before accepting a policy. Then the reinsurance, again in case of the life insurance company. Then you have the concept of the free look cancellation. Then there is a concept of the policy lapse and the revival. Then there is a concept of the policy surrender. Right, policy lapse and revival, and then the policy surrender. Then seventh point is what? The premium collection, accounting and reconciliation. So that is point number 7. Point number 8 is regarding the claims of the life insurance company. Then you have the investments of the life insurance company. Right, so point number 8 done. Right, so point number 9 is regarding the investments of the life insurance company. Right, point number 9 is regarding the investments of the life insurance company. And then you have point number 10, which is regarding the commission payable to the agent of the life insurance company. Right, so this is what we have for our discussion for the life insurance company. Now commission, investments, claim and premium, was it already there for the general insurance company also? Right, was it already there for the general insurance company also? Yes, but it is also there for the life insurance company. Right, in the beginning I discussed it with you over here. Okay, premium, claim, investment, commission, is it there for life insurance company also? Yes, it is there for both the general insurance company as well as the life insurance company. And then what are the other special points? Policy surrender, policy lapse and revival, free look cancellation, reinsurance, underwriting and the actuarial process. process. And initial, what is the number one discussion over there? The types of the life insurance product, right? The types of the life insurance product. Okay. What does the question bank say? Question bank, importance of the actuary and the role of the auditor in the life insurance company. So they are talking about the actuarial process. So that is question number 1, right? That is the question number 1. Then you have a question in RTP number 22, which is regarding the free look cancellation. So RTP number 22, there is a question regarding the free look cancellation, right? Then after that, 5 marks, May 2022, there is a question regarding the policy lapse and revival, right? So question number 3 is regarding the policy lapse and the revival. Are you getting that, right? Then question number 4 is regarding the premium collection, accounting and reconciliation in case of the life insurance company. So that is question number 4. What is question number 4? Regarding the premium collection, accounting and the reconciliation of the life insurance company. Then question number 5 is regarding the investments of the life insurance company. So claim not there. What is next question over there? Question number 5 is regarding the investments of the life insurance company. Then the commission payable to the agent of the life insurance company. So that is question number 6, right? The commission payable to the agent of the life insurance company. And then you have one question regarding the operating expenses. Now what happened? This operating expenses question, have we already discussed it in the general insurance also? Right? 5 lakh or 1% of net premium, whichever is higher, should be shown separately. And expenses not directly related to insurance business are also required to be shown separately, right? So, but why I had to put it under life insurance? Because it says TNT Limited is engaged in the life insurance business, right? That is why that particular question had to come here. Okay, right? So, have we had a look at the question bank as such? Some of you, please don't talk, right? No need for you to talk. Better things to do in life, better to become a chartered accountant in life rather than just be a chatter in life. And why you want to chat so much? And become a chartered accountant better than that. And why you're talking? Don't talk, not required. Okay, right. So now coming to the types of the life insurance product. Okay, in the exam, in the MCQ, how the question can come, right? What the question could be for replacing the purely for the purpose of the income replacement needs, which of the following types of policies could be taken? And again, 4 options: term protection, money back plan, unit link insurance policy, or the pension or the retirement plan. So what you need to know, that is the term protection. Are you understanding how the MCQ could be made in the exam? They will write the name of, write the description of one of the policy. What does it say? It provides cover throughout the lifetime of a person and does not carry any maturity value. So what type of a policy is it? And again, they put 4 options over there: whole life insurance, annuity, group insurance, or the pension or the retirement plans. Are you understanding how the MCQs could be coming, or how the wholesale question can come in the exam? Briefly describes the type of the life insurance product. Can I briefly describe the types of the life insurance product? Again, ribbon cutting ceremony, opening ceremony awaited, right? Opening ceremony awaited. Okay, right. So 2 policies which we first have over there, we'll make sets of 2. One is regarding the term protection and the whole life insurance product, right? Term protection, like when I had given you the example in forensic audit, okay, you pay 40,000 rupees, and if there is an unfortunate death of the policy holder, the insurance company will pay 1 crore. Right? And what if that person does not die during the year? It says it's an operating expense, right? It is an operating expense. Are you understanding? Right. So over here we have the term protection. Term insurance generally takes care of the pure income replacement needs rather than the capital appreciation requirement. Capital appreciation happens where? It happens in ULIP. And the unit link insurance plan. Okay. Now, term insurance covers the policy holder for specific periods. So every year. So you have to take a term insurance for 1 year, 2 year. But generally it is taken for 1 year. And pays the death benefits only if the policy holder dies during the policy period. That's what I told you. They show the fake deaths also. Okay, the person has not died, but showing that he has died, and then getting the money from the insurance company. Are you understanding that? That is the term protection, right? The term policy, term insurance, right? So what many people do, you go to the insurance agents, right? Or you go to the mutual fund agent. These two people are roaming around everywhere. You keep on finding these people, and their advices are not very, very genuine. Very few people to give you the genuine advice. They will always give you the bias advice. Why? What they will always give you advice where the commission is higher. Like, in case if you go, now I'm just telling it because I'm not an agent of any of it. So just generally telling you, right? So like they tell you mutual fund, you should go for a SIP. Right, or you can go for a one-time lump sum payment. So say you have 1 lakh rupee with you, right? So if you go to the agent and say that I want to invest this 1 lakh rupee, what that agent will tell you, what you do every month, you put 10,000 rupees. Every month you put 10,000 rupees. Array, but if that 1 lakh rupee is already with me, why should I put it 10 months? I can put it one go. No, I can put the entire 1 lakh right away. Is it right? Why they suggest putting a SIP? Because in SIP they get more commission as compared to one-time lump sum payment, right? As compared to the one-time lump sum payment, right? So that is why, if you have the funds right now with you, then why to go for SIP? You can directly go for the one-time lump sum payment over there. Are you understanding that? You can go for the one-time lump sum payment over there. Okay, and again, just as Warren Buffett says, you cannot put all your eggs in one basket, right? So again, you need to, but not have too many also, like, every other company you are having, purchasing the mutual fund or something. But yeah, you should have a portfolio management, like a diversification of the portfolio. And current, like, in US and all, they say that people live paycheck to paycheck. Like every day they'll be eating outside, eating the burger and french fries and all of that. And the Indian people who go over there, they work very hard, they work very, they earn a lot of money, they have a saving mentality also. But those people over there, what they have, they don't have any saving mentality or any of that. So and that is why the Indians get more opportunities. But now that culture is coming in India also, it is so surprising for me to see that when you go to a particular mall, if you see a particular jeans over there which is like for 4,000 rupees, it says even that jeans you can purchase on EMI. You understand? You can purchase it on EMI over there, or even a 3,000 rupees, some electric product you like over there. It says you can pay the installment. EMI option is available for the same. And nowadays, what company has started doing, these employees are so greedy. They are living in such a hand-to-mouth situation over there. Rather than giving them monthly check, they are giving them weekly weekly wages. And every week the salary is credited to your account. So literally, I think after a few days, they'll become daily wage workers only. And today you work, today you get 500 rupees. Today you work, today you get 500 rupees. No, right? So you should be very, very responsible about your money. And you should develop that habit. Reading any book does not give you the knowledge. That is not experiential, understanding. No, reading a book about meditation does not teach you what meditation is unless and until you do. Like say example, if I tell you, I give you a nice foreign author book, 500 pages, and it is described in that book in great detail how to drive a car. You understand, in great detail, all the mechanisms and what accelerator, brake, and the clutch, and how you change the gear, and if it's a gearless car, and how the steering is to be operated, how to take the reverse, how to put the indicator, how to put on the wiper, everything. There is one chapter over there. You have thoroughly read this book 3 times. You have understood each and every concept theoretically over there. And now you sit on a car, in a driver's seat in the car. Will you be able to drive the car? Array, you read the book na 3 times. You know it theoretically. But no, will that help you practically? Not at all. And in today's world, now copy paste doesn't work. And somebody else applied some funda, something over there, and you just copy paste their style or their funda, or they did like that. That is why you're doing. I find it very inappropriate to go for copy paste. No, somebody is reading that book. Array, let them read. No, somebody saw that movie. Somebody is seeing this series. Don't you have your own preferences? Don't you have your own selection? Don't you have your own liberty in life to decide how you will spend your time? You should have your liberty, na, ki boss. See, even an Ambani or a Tata has 24 hours in a day. Even you and me are having 24 hours in a day. That much I think God has been fair with all of us. They've not said that, oh, because you're an Ambani, I give you 48 hours in a day, and because you are Aarti Lahoti, I'll just give you 18 hours in a day. Is it like that? No, whoever you are, whatever you are, does every person have 24 hours in a day only? Yes, and how much life is there, that is uncertain. But whatever, till the time life is there, every day which there, how many hours are there? 24 hours. So how we utilize? Don't go over. Now, sometimes, people do goal setting. And until 10th standard in life, you never knew something called as goal. Only football ka goal you knew. I know, never knew. Ye goal setting, easy life, going, playing, and just having a school, getting some 70, 80% here and there, family program, wedding, function, birthday party, happy life. And a very, very happy life. Then came all this, came now adult, and then bank account opened, and now CA course on top of that, and doing all of that. And then all of a sudden, no, I want to become this. You become very strict with yourself, and then you set some goals for you. No, don't be harsh also on yourself. The outcome will not be very, very good. Be disciplined, but don't be harsh. Be disciplined. Follow a particular routine. Be disciplined over there. And be little flexible also with your goals. Little flexible means that, okay, you had thought that this year you will save 10,000. You could save only 4,000 rupees. No problem. Next, further it can be done. So don't, because what happens now, nowadays students, they go into depression, they go into some sort of a mental illness over there. Arey, to not required. No, that's okay. The world is not ending. If you planned something, it didn't happen, CA results you did not clear, it's okay. It's okay. There's nothing great or something very impossible. There are million other bad and wrong things which are happening in the world. It just, it's very scary to live in today's world as such, if you look at the negatives. And where people get the idea from all the Netflix series and all. And in the series, all that full plan put over there, and you see that people doing, and the rationality of mind is not fully developed. No, when you are at this particular age, rationality of mind not developed, not knowing how to handle pressure, coming under peer pressure, going under, some particular influence or something. Don't do all this. Don't do all this. Be fond of whatever you are doing. Anybody, I'm not here to, not just, I'm just telling it just as a concern for all of you. Any bad habits, don't develop. Not required, right? Even is there like, no, these are not the correct things to do. This is just running away from life. This is just not having the ability to face the reality in life. Don't go too much into, okay, some students, they are like very meditative. They are like, if you look at them, you feel saintly over there. Some students are like very fashionable. They are always into trending. Don't do over of anything. Just be like, not here, not there. Just be like a normal person. That works well. That not too much of it, not too less of it, just some normalcy over here. That's fair enough. Meditation means 4 hours in a day. Meditate. अरे भाई ठीक है ना, क्या होगा इतना मेडिटेशन करके, क्या करना है? So much meditation, what, so much doing what? You want to go to Himalaya? No, you want to become chartered accountant now. So where it is required, don't punish yourself. They take a stick and they move behind them. No, you do meditation, you do exercise, you do run. You do, na. You do. If you have akal, if you have your own brains, if you have some sort of basic rationality in your mind, there is no need for you. You're not a school going child now. 1-year-old child, you have to eat him the food. If you don't eat him, give him the food to eat, he'll cry, but he will also not understand why he's crying. You understand? But grown enough, you know what you are supposed to do with your life over there, and what that you are supposed to exercise, or that you are supposed to take care of your health, or that you are supposed to, do the classes, you are supposed to start earning money, you should be creating some source of income for yourself, that every day you watch one particular video, like say for half an hour of some particular. Don't watch too much of what you say, motivational videos also. Sometimes just watch a comedy show. Why always, the motivation, goal setting? I thought sometimes put up some cookery show that lady is speaking something, I'm not even listening to it. I say, you talk something, some entertainment over there. And no, I don't want anybody to tell me about goal setting and be motivated, get up early. I was like, I will decide what I have to do. You understand? Now I'll put up some comedy show or some particular analysis speaking something which is completely not relevant for me. And not relevant, but I'm just listening to it. So even that is a good motivation. You understand? Even that makes you fresh rather than, no, you search video on YouTube, goal setting, how to sit for study for 12 hours in a day. And boss, people put all type of videos on YouTube. So all varieties of videos are available over there, right? So I want you to be sparkling in life, right? So all my efforts all these days, don't put it in dust, huh? Like, please give some heed to whatever efforts or I have tried to convey you in the class. Okay, so even if one life I'm able to make a difference, I'll be so happy for that. Okay, right. So anyways, we are talking about the types of the life insurance product. What are we talking about over here is the types of the life insurance product. So one is what, the term protection, and second is the whole life insurance product, right? So term insurance, every year you buy a policy. You don't die this year, you don't get any money from your policy holder. Survivors of the policy holders don't get any money from the insurance company. But if there is a death, then the survivor of the policy holders, they get the money from the insurance company. So every year you take a term insurance. That is one. And then you pay lump sum 5 lakh rupees to the insurance company and say, in next 20 years, if I die anytime, you need to pay 1 crore rupees to the survivors of the policy holder. So this is also a life cover only, but it is a whole life insurance product. It provides cover throughout the lifetime of a person. And unlike the endowment plans, they do not carry any maturity value. So if 5 lakh in 20 years, if I don't die, nothing, that money is operating expense. What does it say? And some assured is paid to the family in case of the unfortunate death of the policy holder, right? So both are regarding death is what, term protection and the whole life insurance product. Are you understanding that? The term and the whole life insurance product. Okay. Then after that, you have the endowment. That is the pure endowment. What is endowment? Okay, all this, we had seen on the LIC website, so many policies over there, right? So all this Jeevan, Bima, insurance plans over there, which we had seen, Bima Jyoti, Bima Ratna, Bima Sanchay, right? All these policies over there. What are these? That every year you pay some money to the insurance company, and at the end of a particular period, they will pay you that amount, plus they will give you some bonus, plus some assured sum you will receive over there. Are you understanding that? That is endowment, right? So endowment policies covers the risk for a specified period, and at the end of the policy, the sum assured is also paid back to the policy holder, along with all the bonus accumulated during the policy term. So now it is a combination of the income and also the insurance, right? So it is investment plus income, investments plus insurance, right? So not only you are doing the insurance, but along with the insurance, it is also your, yes, investments, it is also your insurance. Are you understanding this, everyone? That is the endowment plan. So if any unfortunate death happens, the insurance company will pay the money. And if you don't die during that period of the policy, at the end of it, will you get the entire sum? Yes. And along with, what does it say? Some accumulated bonus also? Yes. So that is investment plus insurance. That is the endowment policies. Then you also have the money back plan. Again, money back plan policies are the type of the endowment policy. So again, that is why these two we could put together. Which two we put together? Term protection and whole life insurance product. Then what we put together is the endowment and the money back plan. So money back policies are type of endowment policies which provide periodic payments of the partial benefits during the term of the policy, so long as the policy holder is alive, right? So they keep on giving you the partial benefits during the term of the policy when the policy holder is alive. So first they were talking about the death of the policy holder. Now they are telling you can stay alive. And the money back plan over there, and a partial benefits during the term of the policy, so long as the policy holder is alive. Are you understanding that? Here, what did they talk about? The policy holder dies during the policy period, the unfortunate death of the policy holder. Now, what does it say? It is paid to him at the end of the specific period along with the bonus. And also, what does it say? You can stay alive. And it is paid during as so long as the policy holder is alive. Are you getting that? What are the first four? Term protection, whole life insurance product, endowment policy, and the money back plan. Right. Then what are the next two which you have over there? ULIP and the pension or the retirement schemes, retirement plans. So ULIP, right? ULIP means what? Which is linked to this, whatever investment you do in the insurance company, that insurance company invests it in the stock market. So based on the fluctuations in the stock market, again, accordingly the value will change of your investment, right? So ULIP are such insurance plan where the value of the policy the changes as per the underlying investment assets. It allows protection and flexibility in the investment. The premium paid is used for the purchase of units in the investment asset, right? So whatever premium you pay, what does it say? From that so it's type of a mutual fund only. And this is type of a mutual fund only. That is the ULIP. And then pension or retirement plan. Okay, when you are working, and when the years you are working, what you say you decide you're going to work up to the age of 45, right? So up to the age of 45, you deposit some money with the insurance company. And then after you retire, then what does it say? Every month you say, insurance company, you need to give me 20,000 rupees, right? Every month you need to give me the 20,000 rupees. Okay, so pension plan is a retirement solution where policy holders decides the retirement age and agrees to pay the premium till the time of the retirement. So till the age of the retirement, right, the policy holder will pay the premium, and thereafter he has an option to commute a part of his fund value and take an annuity for the balance. So either you can take the lump sum 20 lakh rupees, or every month 20,000 rupees also you can take, right? So that is the pension or the retirement schemes. Are you understanding that? Term protection, whole life insurance product, endowment policy, money back plan, then the ULIP and the pension or retirement scheme. Then you have the annuities, right? Annuity is a contract where an insurer, in return for the payment at the regular interval, just till fixed date, marks series of agreed payments at regular intervals from a fixed date. So after 5 years of the policy, you'll get 2 lakh. After the next 5 years, you'll get more 2 lakh. After more 5 years of the policy, you'll get further amount, right? So that is where you keep on getting the annuities, like, sort of like getting the dividends or so. Then group insurance is generally taken for the employees of an organizations or a professions in a common group. Like, ICICA Institute also has some particular tie-up with an insurance company for the taking the, insurance policy for a chartered accountant, for the life of a chartered accountant, right? So that's a group insurance which can be taken, and others which is not covered in the above plans, right? So annuities, group insurance, and then you have the others. Okay, right? So no question asked either in the wholesale or the retail or the MCQ part of the paper regarding the types of the life insurance product. Is it clear to everyone? Right? The types of the life insurance product. And now coming to the first question, which is an RTP question over there, the actuarial process. Right? So do actuary play an important role in case of the insurance company? Rather what we had seen in the audit report? Okay, auditor, you have to certify whether actuarial valuation of liabilities have been certified by the actuary. Yes, whether the actuarial valuation of liabilities have been certified by the actuary. That auditor needs to certify in his report. Right. So what is the importance of actuary in an insurance company? What is the importance of an actuary in an insurance company? So it says the actuaries, they are the calculating and the modeling hub of the insurance company. What they do the detailed analysis of the data to quantify the risk. So it says the role of actuary is getting tremendous importance in the life insurance business. And their role is not only with checking the compliance to certify products and financial report, right? It has shifted from supervising compliance to certify the products and the financial report. So they are not only checking compliance, but they are also certifying, okay, yeah, this product is good, financial condition is good, right? So the role of actuary is changing in the life insurance business. Okay. And what does it say? The role of the actuary, the department of actuary in the insurance business, what is they say? The entire bandwidth of their role, from pricing to policy valuation technique. Okay, what should be the price of this policy? What should be the value of this policy? That every month if you pay 5,000, then at the end of the year 60,000 gets accumulated, but the insurance company will give you 73,000 rupees. So who will decide this? This will decided by the actuary, the pricing and the policy valuation techniques. Are you understanding? Right. So what are the key areas where the actuarial department broadly concentrates in the insurance business? Right. So one, regarding the product development and the model development. That is the new business development or the product development. Pricing and experience analysis. Then also what do they look into in case of the insurance company is the statutory valuations and the business valuations, right? The statutory valuations and the reserving, like they have to maintain the unexpired risk reserve and so, and also the business valuations. And in addition to that, what are two more points over there? The business planning and the solvency management, right? The business planning and the solvency management, right? So what is this? This is the work of the actuary in an insurance insurance company. What does it say? The actuary is gaining tremendous importance. It's shifting from the supervising compliance to certifying the products and financial reports. What do? They do the detailed analysis of data to quantify the risk. They are the calculating and the modeling hub of the insurance company. And what are the broad areas where they can be providing their services? Product development, model development, business valuation, statutory valuation, business planning, and the solvency management. Then what auditor has to do? Auditor in his report has to certify whether actuarial valuation of liabilities have been certified by the actuary. What auditor has to certify? Whether actuarial valuation of liabilities has been certified by the actuary. Right? And obviously, when you're using the work of the actuary, what are you doing? You're following SA 620, using the work of the auditor's expert. So what it says over there, can auditor rely on the certificate of the appointed actuary? Auditor generally can rely, but can you blindly rely? No, CTBR, you continue to be responsible. That is why what you need to do, you should have a discussion with the actuary regarding the process followed and the assumptions made by him before certifying the policy liabilities. So it says you have a discussion with the actuary regarding the process which he followed and the assumptions which he made while calculating the policy liabilities. Are you understanding that? The importance of the actuarial process and what is the role of the auditor. What is the role of the auditor? Auditor needs to certify whether the actuarial valuation of liabilities have been certified by the appointed actuary. And can he rely on the certificate of the actuary? Yes, he can rely, but he cannot blindly rely. So he needs to have a discussion with the actuary regarding the process followed and the assumptions made. Okay. Underwriting. This concept had I discussed with you in general insurance company also. Okay, when you apply for a policy, do they immediately issue the policy to you? No. What they do the verification, right? So proposal is an application for an insurance cover, and the process of screening the applications, the process of verifying the level of risk in each new entrant is called as the selection or the underwriting. The process of verifying the level of risk in each new entrant, right? So how much is the risk, right? So if a particular person is having sugar or so, accordingly the premium amount will be higher. If having any heart disease or so, having higher cholesterol or so, then what does it say? Accordingly the premium amount will be higher. Are you understanding that, right? So process of verifying the level of risk in each new entrant is called as the selection or the underwriting. What does it say? While verifying the process of underwriting, now what is the objective of audit? Now all these points over here, what they do now, in the first part they explain, okay, what is it? What is the meaning of underwriting? And then after that they say verification. M means what? The meaning. And okay, what is the meaning of underwriting? And V means what? It means the verification. Verification means what? It means the audit procedures. And verification means, V means what? The verification. That means it is talking about the audit procedures, and it is talking about the audit procedures. So what is the objective of the auditor? To review the process of acceptance of the risk through the underwriting process and test the effectiveness of the internal control to ensure timely and accurate insurance policy adherence to the IRDA Act and the regulations. Right. If you look at the next heading also, what is the first part over there? Reinsurance means one insurer purchasing coverage from a second insurance company for the risk that the first insurer is insuring. So this is the meaning. And then the audit in this regard would normally cover the following areas. What will the audit cover? Verification of the agreements, updating renewal of the agreement, and verification of the payments made to the reinsurer. Right? So that is the meaning and the verification. Are you understanding that? What is the meaning of the reinsurance? And then the V. What is the V over there? Verification of the agreements entered into. Then any updations or renewals of the agreement, and the verification of the payments made to the reinsurer, and whether adequate provisions are carried out in the books. Are you understanding? If you look at the next heading also, what is the first few points over there? It is regarding the meaning and the primary objective of audit. That means it is the verification. Are you able to appreciate this part of the distinction over there? Okay, there is the meaning. Okay, what is free look cancellation? And then after that, you also have the verification. Okay, right. So now policy holder applied for a policy and an application for policy done. Then what will the insurance company do? They will do the underwriting. After the underwriting is done, then the policy will be issued. And now the policy holder, is he in receipt of the policy documents? Policy holder, has he received the policy documents? In receipt of the policy documents, the policy holder, yes. And now what does it say? After he receives the policy documents, he reads the policy documents and he said, oh, these terms and conditions are not acceptable to me. What type of policy have they issued to me? So within 15 days from the date of issue of the policy documents, what does it say? The policy holder has an option to return the policy. Within 15 days of the issue of the policy holder has an option to return the policy. So then that case, what the insurance company will have to do, whatever premium they had received on that policy, that premium they will have to refund, and with a proportionate deduction of, say, 13 days insurance cover was given. So for that 13 days, the premium will be deducted, and any medical expenses were incurred. So again, that will be deducted, right? So premium is to be refunded subject to any expenses which have been incurred by the insurance company, right? So this is the concept of the FLC, free look cancellation. Who has the option to cancel the policy? The insurance company or the policy holder? The policy holder. Within 15 days from the receipt of the policy document, he has an option to order the insurance company to cancel the policy. If the insurance company receives such a request, now what does it say? The primary objective of the audit is what? To check and confirm that FLC requests are received within 15 days from the receipt of policy document by the policy holder, verification of the signatures and processing of the FLC request as defined by the insurer, and also check the appropriateness of the accounting entries which are recorded for the refund. So do you understand? Once you know the meaning, then you have to write down the audit procedure. So within 15 days of the issue of the policy, right, the policy holder can review the terms and conditions of the policy, and whether insured disagrees to any of these terms and conditions, he has the option to return the policy, stating the reason for his objection. Yes, in that case, will he be entitled to a refund of the premium paid? Yes, he will be entitled to a refund of the premium paid, only to a deduction of the proportionate risk premium and the expenses incurred by the insurer on the medical examination of the proposer and the stamp duty charges. So what are the three things which will be deducted from the premium? A proportionate risk premium, say after 13 days he applied for the cancellation, then the medical examination and the stamp duty charges. Then how can the FLC request be received? It could be received by email, fax, letters, depending on the insurer's policies. In case if it is received through letters, written letters, the signature of the policy holder should be matched with the original proposal form. Are you understanding that? Then FLC request is processed only when the policy holder is not satisfied with the terms and conditions of the policy document, and not for any other reason. Do I see a case study coming up from there? Right? He says, for any, if you don't not satisfied with the terms and condition, only for that reason, it says you have got a better policy, that is why you want to cancel this policy. No, what is the only reason it says? Not satisfied with the terms and condition. An FLC refund is paid either by the check, or in case of policy holder wants the direct credit, then the consent for direct credit along with the cancel check for the bank account details is to be submitted, right? So what is that? That is the discussion regarding the free look cancellation, right? So there in RTP number 22, right? So what are we discussing now? Life insurance company. What we discuss? Types of life insurance product, actuarial process, underwriting, reinsurance, and the free look cancellation, right? So we have 6 more points to discuss, right? So we'll discuss these points, and then after that also go to the chapter of the audit of the public sector undertakings. Okay.